Welcome to the Royal Tax Podcast with your hosts, Megan Templeton, Royal Legal Solutions Consulting Attorney, and Royal Legal Solutions CPA, MBA, and CFO, Pete Schindele. Each week, they talk about how to take your tax and financial strategy to the next level and learn how to build and scale your real estate investing business in a way that maximizes your returns and minimizes your taxes. This is for informational use only. For direct questions, please contact us or your local tax CPA accountant.
All right. So we will go ahead and hop into the presentation then. So I see we already got some chatter going on over here in the chat. Looks like it's mostly our staff, but like I said, feel free to utilize that chat as we go. And then, so why don't we do this, Pete? Let's start off, you've given us what are we talking about today. So why don't we talk about the who this is for, who really needs to be leaning in and can you benefit from this information?
I think the primary people that would benefit from today's information is those who have large net operating losses, real estate losses, which the passive real estate losses, if they can get that real estate professional designation, can become active losses. And then the other group would be people who believe that tax rates will be much higher in the future than they are today. So those would be the two main individuals that would probably gain a lot about having a Roth IRA conversion or just a traditional IRA or traditional 401k converted into a Roth.
Gotcha. Okay. So tell us a little bit about what that actually means. I mean, what are the foundational pieces of that? I mean, and that probably has to lead into a little bit like, would you use the IRAs for? When we have these conversions, that type of thing. So if you wouldn't mind, just give us kind of a general background on it.
Yeah. So a traditional IRA, a traditional 401k, that's when you contribute money into a savings retirement account pre-tax. So you put $1 in, it lowers your current taxes today. But when you get in retirement and pull those dollars out, it's taxed at whatever your income tax rate is in the future. So those are what the traditional IRA and 401ks are for. And those can grow significantly over time with the time value of money and with the way the stock market does returns. So you may not want to pull them out when you're older and in retirement because your tax rate could be double. It could be significantly higher. So one way to avoid the future tax rate is to do partial conversions today or over the course of the next 10, 20 years, depending on your investment timeline. And the reason you want to do those partial conversions is you will have to pay today's tax rate or tomorrow's tax rate, depending when you do that conversion, but you'll know the hit that you're going to take tax-wise. And then when you're older and pulling those money out in your retirement years, hopefully, those dollars have doubled or tripled based on your investments, then you get to withdraw those tax free.
Okay.
So you have a little more control on planning what your taxes are because you have more of the knowing aspect.
Okay.
You don't have to convert the entire amount. You can do partial conversions, which is what we're kind of focused on today. And the reason we like the partial conversion is, let's say you had a net operating loss of $30,000. Well, you could convert $30,000 from your traditional IRA into a Roth, and those two items are going to wash. So when you have $30,000 in income with the conversion and a $30,000 loss in your business, that's a zero tax benefit. So you can do a conversion and not have to pay any taxes on it. And then now that's in Roth dollars. And you could put those in a Roth solo 401k, which we've talked about in the past in previous episodes.
Okay. So what comes top of mind for me then is what I heard is the triggering event maybe for this conversion is going to be when you've got a loss you're looking to use to offset. Is that right? Yeah,
that'd be the primary ways you want to offset a loss. Additionally, let's say you just had a down year, you're self-employed and your income wasn't there. Let's say you had a lot of renters that didn't pay rent expense. Now you have a bigger loss in your real estate business. Well, instead, maybe normally you're making 100,000, maybe you're only making 70,000 this year or 60. You could do that conversion. It's going to put you back to your normal estimated profit, income of that $100,000 level. So You can also do this when you have no losses, as long as your income's down.
Okay. So recap, what we're looking here is if we have got losses that we want to use to offset our tax burden, or if our income is down, these are good triggering events to use this partial conversion strategy.
Correct.
Okay.
Or if you just want to bite the bullet and pay the tax that you know what it is today, regardless of losses, regardless of income, but you know the tax is X amount of dollars and you feel comfortable with it, you could do the conversion now or partial conversion.
Okay.
Not have it offset by any losses, but you know what you're paying.
I got you. So it's that's kind of the peace of mind component to it. If you're looking at, future forecasting and you're saying rates are going to be wild, I need to go ahead and move these type of items. So really we've got three. We've got a peace of mind component. If we think that we're going to pay a lot more later on, we can do this conversion now. Other one is if our income, if we are just lower for the year, that's a good time to think about it as well. Or if we've got losses we're going to use to offset. So we've really got kind of three triggering events. Is that right?
Correct.
Cool.
Yes.
And so what does a conversion look like?
Want more information? Join our community groups that exist to provide a space for like-minded people on a similar journey to learn, share, and network with real estate investing professionals and entrepreneurs. We meet weekly for an hour in Zoom to offer knowledge and accountability. Be sure to grab the link in our show notes.
So what happens with a conversion is you would contact whoever's managing your money, whether it's you personally with your, let's just say it's Charles Schwab. You say you want to do a partial Roth conversion. So what they'll do is they'll set up a new Roth 401k, a Roth IRA for you, and then they will transfer the money from your traditional into this new Roth. And then that has to be done before the end of every year. So you have to make that decision before year end. And then when you go to pay your taxes, in essence, in April of the following year, you'll pay your taxes on the amount that you did the conversion.
Okay.
If there's no loss to offset it.
Gotcha.
You don't want them to, when I say them, we'll go back to the Charles Schwab example. You don't want them to pay you and then you put it into the Roth account. You do that, you're going to get charged with like a 10% early withdrawal fee. So if you ever do the conversion, make sure it's the Charles Schwab, Fidelity, whoever's managing your 401k or traditional IRA, have them do the transfer so you avoid that 10% early withdrawal tax.
Okay, that makes sense. So from the way I'm looking at this, then we've potentially got probably maybe 4 parties, at least 3 involved. So we've got one is going to be myself. I've got to be looking at my situation, figuring out if this is a good triggering event. Should I go ahead and do this conversion? And maybe there's a financial planner involved in that as well if I've got one on my team that's advising. So that's possibly 2 parties. This third party is going to be my actual institution who's going to handle that conversion for me. And one of the things I noted that you said is you need to make sure it's someone who's really knowledgeable about this setup so that they know how to distribute the funds where you're not going to get that penalty on the front end. And then the fourth party would actually be your CPA. It sounds like there's a end of your tax filing component to this. So we're going to need to loop our CPA in this as well. Is that right?
Correct. And mostly your CPA will be able to kind of give you a forecasted plan based on kind of historical income and facts that you've described to them. And they'll be able to model how much you should convert.
Okay.
For that partial conversion.
Okay. So
your financial planner could as well. So
that makes sense. Yeah. So when I'm thinking about doing this, I mean, I've got to have a knowledgeable contact at my company who's going to handle the conversion. I've got to have a knowledgeable CPA. Other than setting those things in motion, though, and directing those actors to do those items, what is required of me to have this conversion take place?
You would have to set up the new account with the financial institution, and you would have to let them know how much you want to contribute and how much you want to do, whether it's a full, partial, or so forth. So you're kind of the decision factor and director in that aspect.
I got you. Okay. And so another question that's kind of top of mind for me on this is, we've talked about partial conversion. When would we be considering a full conversion? Like, when is something we need to talk about a full conversion on?
A full conversion, it really it depends on your tax appetite. If you don't have a lot of money in the IRA and you could do a whole conversion at once. If you have a couple $1 million in the IRA, you probably don't want to do that all at once. So it really just depends on how much tax the person wants to pay today, what their other income is. based off operating losses or W-2 wage or self-employed wages.
Okay.
There's no magic number. I would argue when you do meet with your tax planner or your financial advisor or tax CPA, they can model to where you obviously wouldn't want to probably take too much out to put you more than 1 or 2 brackets up, but you could if you want to.
Okay.
So,
That makes a lot of sense. All right. So I think I've got the who, what, why, and how down inside of this. So what am I missing though? What are some other things we need to know about this?
so when you do the Roth conversion, when you do take those dollars out after you reach 59.5 or even later, those are all tax-free. So
Okay.
you're not gonna have to pay income taxes on those. So as you set up your real estate business to where hopefully in 10, 20 years, you're making a lot in rents, and those will be passive income, or it could be active income if you're a real estate professional. Pulling out your requirement and distribution through the Roth isn't going to add to income. So your income tax isn't going to be your rental income plus your retirement income if you're pulling that out. Well, with a traditional IRA, what you pull out, that's tax, plus you're going to be also paying tax on your rental receive or income if you have it in your rental business. So the theory is, when you're 10, 20 years down the line, tax rates are estimated to be much higher. You're going to be paying a lot more tax on 2 sources of income instead of just one.
Okay. Well, I think that makes a lot of sense. Well, anything you think we should cover off on right now, Pete, before we go into breakout rooms again?
Again, when you do the Roth conversion, you can't touch the money for 5 years. Unless you become 59.5, then you're able to pull that money out.
Okay.
So if you have a property and it's been there for more than 5 years, or you're in essence 60, you could theoretically deduct 100% of that Roth and buy a property with it and not have to pay tax like you would on a traditional.
Okay. Well, that sounds great.
Thank you for listening to the show today. If you're feeling overwhelmed with taxes as they relate to your real estate business and investments, or you're unsure if you're doing your accounting correctly, fill out our 5-minute quiz. With the information from this quiz, you'll schedule a meeting with a Royal Legal Solutions advisor who will provide you with powerful tax-saving strategies on your first call. Go to www.royallegalsolutions.com/tax to fill it out.